Las Vegas has always sold itself as an escape, a place where money moves fast, lights stay bright, and risk feels temporary. But beneath that image, Vegas has another role, one it never advertises. It is a pressure chamber for the American consumer economy. What breaks here usually breaks everywhere else later. When a multi-billion-dollar casino starts losing hundreds of thousands of dollars a day, this is not just a business story, it is a signal that discretionary money is drying up, that confidence is eroding, and that the economic model built on constant spending is beginning to fail. This story is not about one resort, it is about what happens when an economy designed for abundance collides with a population running out of room to spend. Losing $400,000 every single day sounds like a headline meant to shock, and on the surface, it works. A luxury casino on the Las Vegas Strip bleeding that much money immediately triggers familiar assumptions. Poor management, bad marketing, or a project launched at the wrong time. But that framing misses the deeper reality. When a mega resort of this scale fails at this speed, the problem is no longer local, it becomes systemic. Fontainebleau is not a small business experiment, it is a multi-billion-dollar development built with market research, financial modeling, and years of forecasting. A loss of $400,000 per day does not happen because executives forgot how to run a hotel. It happens when the assumptions behind the entire business model no longer match the economic condition of the audience it relies on. This is not a marketing problem, it is a demand problem. Luxury hospitality depends on discretionary spending. It survives on money that people do not need for rent, food, insurance, debt payments, or emergencies. In today's America, that category of money is shrinking. Wages have not kept pace with inflation, household debt has climbed to historic levels, and even higher income earners are becoming more cautious. The result is not empty cities or abandoned travel, but thinner spending everywhere. People still show up, but they spend less, stay shorter, and avoid risk. A casino losing $400,000 a day is not just failing to attract visitors, it is failing to extract enough value from each visitor to cover its fixed costs. Massive buildings, staffing requirements, energy usage, debt servicing, and maintenance do not scale down when consumer confidence weakens. These costs remain constant, while consumer behavior quietly changes. That gap is where the losses are born. What makes this collapse more revealing is its timing. Fontainebleau did not open during a recession. It opened during a period when official economic indicators still claim resilience. Employment numbers remain strong on paper. Consumer spending is still reported as healthy. Yet beneath those statistics, behavior tells a different story. Americans are prioritizing survival over indulgence. They are cutting back not because they want to, but because they have to. This is not a story about a single casino losing money. It is a warning signal from a consumer-driven economy that has reached its limits. When institutions designed to absorb enormous amounts of discretionary spending begin hemorrhaging cash, the problem is not execution. The problem is that the economic foundation underneath them is quietly eroding. $400,000 a day is not just a loss. It is the sound of a system telling us something is wrong. Fontainebleau was not built for the average American. From the very beginning, its design, pricing, and positioning made that clear. This property was engineered for a specific type of consumer: high-spending leisure travelers, convention elites, and luxury tourists who treat Las Vegas as a playground rather than a budgeted trip. In theory, this audience is small but powerful. In practice, that audience has been shrinking for years. The assumption behind Fontainebleau was simple. There would always be a steady supply of affluent consumers willing to spend freely on premium rooms, high-end dining, upscale nightlife, and extended stays. This logic worked in the past, particularly in the decade following the recovery from the 2008 financial crisis. During that period, asset prices rose, credit was cheap, and spending felt painless. But the economic conditions that supported that consumer no longer exist. Inflation quietly reshaped American behavior. Even households with strong incomes began to feel pressure as food, housing, insurance, and healthcare costs rose faster than wages. At the same time, interest rates climbed, turning credit from a convenience into a burden. Mortgages, car loans, credit cards, and business financing all became more expensive. What disappeared was not wealth itself, but confidence. And luxury spending depends on confidence more than income. Convention travel, once a reliable backbone for large strip properties, has also changed. Companies are more selective, budgets are tighter, and many organizations have learned to operate with fewer in-person events. The assumption that convention elites would continuously fill premium rooms at premium prices has proven overly optimistic. The volume is lower, and the spending behavior is more restrained. Luxury tourism faces the same problem. International travelers are more cautious. Domestic travelers are shorter stay visitors. High-end tourists still exist, but they are fewer, more selective, and less loyal. They are no longer willing to spend simply because a property is expensive. They demand value, flexibility, and relevance. A massive, expensive structure alone is no longer enough. In today's economy, the luxury consumer is not extinct, but fragmented and defensive. They spend selectively, avoid excess, and hesitate before committing. A business model that depends on constant high-spending behavior from a narrow audience becomes fragile the moment that audience changes its habits. Fontainebleau did not misread its branding, it misread the moment. This property arrived not early, but late. Late to recognize that the American luxury consumer has evolved. Late to acknowledge that the market has tightened. Late to accept that abundance has given way to caution. Fontainebleau was built for a version of America that no longer exists at scale, and that mismatch is now written into its balance sheet. For decades, corporate America has clung to a powerful myth. If a product is expensive, it must be resilient. Luxury, in this logic, is seen as insulated from economic downturns. When budgets tighten, the thinking goes, mass market spending collapses, while high-end consumers continue as usual. Las Vegas was built around this belief, and Fontainebleau is one of its clearest expressions. But reality is now exposing how fragile that assumption truly is. Luxury does not survive on necessity, it survives on excess. Every dollar spent on a premium hotel room, a high-limit table, or an upscale restaurant comes from discretionary income, money left over after life's obligations are paid. That surplus is what fuels luxury ecosystems. When that surplus disappears, luxury doesn't slowly decline, it drops suddenly. What makes this illusion dangerous is how convincing it once seemed. In earlier cycles, affluent consumers appeared stable even during downturns. Asset prices recovered quickly, credit flowed freely, and spending resumed with little hesitation. But the current economic environment is fundamentally different. Inflation has reached into every household, not just those living paycheck to paycheck. Rising costs have eaten into margins at all income levels, compressing the very surplus that luxury depends on. The American middle class sits at the center of this shift. While often excluded from the definition of luxury consumers, they have historically provided volume. Middle-income travelers filled rooms during promotions, attended shows, ate at restaurants, and fed the broader ecosystem surrounding high-end resorts. Today, that group is financially exhausted. Discretionary money is no longer a buffer. It has become a liability. Even higher-income households are behaving differently. Wealth no longer guarantees confidence. Market volatility, high interest rates, and economic uncertainty have turned spending into a calculated decision rather than a reflex. The idea that luxury customers are immune to hesitation no longer holds. When uncertainty rises, even the wealthy pause. The belief that luxury is recession-proof was never a law of economics. It was a temporary condition created by cheap money, rising asset values, and collective optimism. That environment is gone. What remains is a luxury sector built on assumptions that no longer reflect reality. In today's America, discretionary income is not just shrinking. For large segments of the population, it has vanished entirely. When the surplus disappears, luxury does not adapt gracefully. It collapses under its own weight. Fontainebleau's struggle is not an anomaly, it is a direct consequence of believing that high prices alone can protect a business from economic gravity. Casinos are often misunderstood as businesses built for high rollers. The image is familiar: private rooms, million-dollar bets, and a small group of wealthy gamblers driving massive profits. In reality, this is a misconception. Casinos do not survive on exclusivity. They survive on volume, and without consistent mass-level traffic, the entire model begins to break down. High rollers generate headlines, but they do not create stability. They are unpredictable, expensive to cater to, and volatile in their behavior. The real foundation of a casino's revenue comes from thousands of ordinary guests making small, repeated decisions. A few dollars on a slot machine, a modest table bet, a drink at the bar, a meal after hours on the floor. Individually, these transactions are minor. Collectively, they are everything. When crowd volume declines, the impact is immediate and unforgiving. Empty tables are not neutral assets. They represent lost potential every minute they remain unused. Silent slot machines do not recover revenue later. Once that moment passes, it is gone forever. Restaurants without foot traffic burn cash through staffing, utilities, and inventory, regardless of how many customers walk in. None of these costs pause when demand weakens. Casinos are designed around constant motion. Energy usage, staffing levels, security, surveillance, maintenance, and compliance operate on a fixed schedule. These systems are expensive and non-negotiable. They assume steady crowd flow. When traffic slows, revenue contracts while costs remain rigid. The business does not bend, it fractures. This is why crowd behavior matters more than individual wealth. A casino filled with average players creates rhythm, momentum, and sustainability. A casino waiting on a handful of big spenders creates volatility and risk. The absence of crowds signals not just a slow night, but a structural imbalance between operating costs and consumer participation. What is often ignored is who those crowds represent. They are not elite gamblers. They are middle-class visitors, teachers, service workers, small business owners, retirees, and families stretching a budget to take a short break. These guests may not spend extravagantly, but they spend consistently. Their presence keeps the ecosystem alive. When the middle class weakens, the experience economy weakens with it. Casinos, shows, restaurants, and entertainment venues do not exist in isolation. They rely on a broad base of participation. Without a healthy middle class, the volume disappears, and without volume, even the most glamorous casino becomes a financial liability. A casino without crowds is not simply underperforming, it is operating against its own design. The failure is not about branding or prestige, it is about the absence of the economic engine that makes the entire experience economy function. A price tag of $3.7 billion is often presented as proof of ambition. In corporate storytelling, numbers this large are framed as bold bets on the future, symbols of confidence and long-term vision. But size alone does not equal intelligence. And in this case, the scale of the investment reveals something far less admirable: overconfidence. Fontainebleau was built as a super mega resort at a moment when American consumers were quietly scaling back. Travel was becoming shorter, cheaper, and more cautious. Families were downgrading vacations, business travelers were trimming expenses, even luxury consumers were becoming selective. Building one of the most expensive resorts on the Strip during this shift was not visionary, it was disconnected. The assumption behind the investment was that a big name could overpower economic reality, that brand recognition, architectural spectacle, and sheer scale would automatically generate demand. This thinking belongs to an older corporate era when attention was easier to capture and consumer loyalty was more predictable. Today's audience is not impressed by cost alone. They evaluate value, relevance, and risk before committing. Mega projects carry a dangerous psychological bias. Once billions are committed, executives become emotionally invested in the idea that success is inevitable. Warning signs are minimized. Market signals are rationalized. Criticism is dismissed as short-term noise. The project continues not because conditions support it, but because admitting error becomes too costly to confront. This mentality is not new. It echoes the pre-2008 mindset when corporations believed scale could outrun fundamentals. Bigger buildings, more leverage, and stronger branding were seen as protection against downturns. When the crash came, those same projects became liabilities almost overnight. The lesson was supposed to be learned. Instead, it was postponed. What makes the $3.7 billion figure so revealing is how little flexibility it allows. Massive resorts are not adaptable. They cannot pivot quickly, downsize efficiently, or test alternative models. Once built, they demand full participation from the market. If consumers hesitate, the structure does not forgive that hesitation. It punishes it. This was not a failure of imagination. It was a failure of restraint. True vision would have acknowledged changing consumer behavior and built accordingly. Overconfidence assumed the past would repeat itself. Fontainebleau stands as a reminder that in modern America, scale without alignment is not strength. It is exposure. A multi-billion-dollar price tag does not guarantee relevance. It only magnifies the cost of being wrong. Las Vegas has always functioned as an early warning system for the American consumer economy. Long before weakness shows up in official data, it appears here first. When people feel confident, Vegas fills up. When anxiety sets in, Vegas empties quietly. What is happening on the Strip today is not an isolated downturn. It is a preview. The signs are already visible. Foot traffic is thinner, discounts are deeper and more frequent. Promotions that once felt generous now feel desperate. Complimentary perks are harder to earn and easier to lose. Behind the scenes, labor costs are being squeezed, hours are reduced, and staffing levels are carefully controlled. None of this is accidental. It is a response to consumers pulling back. Vegas reacts faster than most industries because it depends entirely on discretionary spending. There is no essential version of Las Vegas. Every dollar spent here is optional. When Americans begin to feel pressure, this is one of the first places they cut. That sensitivity makes Vegas volatile, but it also makes it honest. It reflects consumer sentiment without filters. What is unfolding here will not stay here. The same economic pressures shaping Vegas are already moving through other sectors of the experience economy. Theme parks will rely more heavily on discounts to maintain attendance. Cruise lines will compete aggressively on price while cutting onboard perks. Luxury malls will struggle with declining foot traffic and shorter visits. Premium sports events will lean harder on dynamic pricing and corporate sponsorships as individual ticket buyers hesitate. These industries share the same vulnerability. They require participation, volume, and confidence. When any one of those weakens, the entire model strains. Vegas exposes this vulnerability first because it has no buffer. It cannot disguise slowing demand as necessity or long-term contracts. When people stop spending freely, it shows immediately. There is a reason Vegas has preceded past economic downturns. It captured shifts in behavior before they were officially acknowledged. Empty hotel rooms, aggressive comps, and labor compression were not causes of past crises. They were symptoms. Today, those same symptoms are returning in familiar patterns. What makes this moment different is how normalized the strain has become. Discounts are framed as value. Tighter comps are framed as efficiency. Labor pressure is framed as optimization. But these are defensive moves, not signs of health. They indicate a system adjusting downward to survive. Vegas is not collapsing in isolation, it is transmitting a message. The American consumer is becoming more cautious, more selective, and more constrained. The experience economy is beginning to feel the weight of that shift. As always, Vegas is simply the first place where the truth becomes visible. When a casino loses hundreds of thousands of dollars a day, the financial pain does not travel upward, it moves downward. Losses of this scale are not absorbed by executives or shareholders in any immediate or meaningful way. They are redistributed to the workforce, quietly and systematically. Casino operations offer many places to cut without triggering headlines. Dealer shifts are shortened, housekeeping schedules are tightened, food and beverage staff see fewer hours and smaller teams. Valets and security are spread thinner across the same physical space. On paper, these changes are described as efficiency. In reality, they are wage reductions by another name. Tips, a critical part of income for many casino workers, decline as foot traffic weakens. Fewer guests mean fewer opportunities, and cautious guests tip less generously. For workers, income becomes unpredictable, even when they show up on time and perform the same labor. The volatility of consumer behavior transfers directly into household instability. Contracts become more restrictive as well. Temporary staffing increases. Overtime disappears. Benefits are harder to qualify for and easier to lose. These adjustments rarely violate labor laws, but they exploit the gray space within them. The burden of flexibility is placed entirely on workers, not on management. What makes this dynamic so persistent is its invisibility. Executive compensation is insulated by long-term incentives, deferred bonuses, and contractual protections. Shareholders absorb losses gradually through valuation changes, not through immediate income shocks. Workers, by contrast, feel the impact in real time. A missed shift is a missed paycheck. This is not unique to casinos. It is a recurring pattern across the American service economy. When revenue falls, labor becomes the shock absorber. The risk flows downward because it is easier, faster, and politically safer than confronting structural problems at the top. Vegas simply concentrates this reality. Thousands of workers depend on discretionary spending for their livelihoods. When that spending slows, the instability becomes visible, the glamour fades, and what remains is a workforce carrying the consequences of decisions they did not make. This is the classic American imbalance. Profits are protected at the top, while risk is absorbed at the bottom. Casino losses do not dismantle executive lifestyles. They reshape workers' lives. When luxury hospitality begins to fail, the response is rarely innovation. In Las Vegas, the default solution is far simpler and far darker: push gambling harder. When rooms stop filling and restaurants slow down, casinos do not fundamentally rethink their model. They increase pressure on the one mechanism that still generates immediate cash flow: the gambling floor. This shift is not subtle. It appears in tighter game odds, more aggressive player tracking, reduced transparency, and increasingly sophisticated behavioral nudges designed to keep people betting longer. Promotions become less generous, but more frequent. Losses are reframed as loyalty opportunities. Risk is disguised as entertainment. What changes is not the product, but the intensity of extraction. As the high-end consumer retreats, the industry recalibrates its focus. The target quietly moves downward. Lower-income players, local gamblers, and financially stressed visitors become more important to revenue stability. These customers may not wager large amounts at once, but they gamble persistently. That persistence is what casinos monetize. This is where the problem crosses from economic into moral territory. Gambling revenue thrives not on prosperity, but on vulnerability. The more desperate the player, the more predictable the behavior. Financial stress, debt, and emotional fatigue make people easier to retain on the floor. Losses are chased. Time stretches. Spending disconnects from intention. Predatory practices do not need to be illegal to be effective. They operate through design, layouts that eliminate natural stopping points, loyalty systems that reward losses more than wins, complementary perks that feel free but exist to extend exposure. Every detail is optimized to keep people engaged even when engagement no longer serves them. What makes this model sustainable is normalization. Gambling is framed as harmless fun, a personal choice, a form of escape. Responsibility is placed entirely on the individual, while the system that profits from prolonged failure remains invisible. The economic pressure that drives people to gamble more aggressively is never addressed. It is simply exploited. As luxury revenues weaken, reliance on this extraction intensifies. Gambling becomes less about entertainment and more about compensating for structural weakness elsewhere in the business. Las Vegas often presents itself as an engine of excitement and aspiration, but in moments like this, it reveals a different truth. When the experience economy falters, gambling is not a solution. It is a pressure valve that releases corporate risk into individual lives, and the longer this dependency continues, the higher the social cost becomes. Kalau lo mau, next kita bisa lanjut segmen 9 atau segmen 10. Kesimpulan besar dengan nada yang makin gelap dan reflektif. Tinggal bilang lanjut segmen berapa.